All right, welcome back, everyone. It's Brian Strain here. Boy, a lot changed since last week, huh? It's kind of interesting to me that things can change so quickly, and in some aspects, didn't really change that much. Not at least not as much as I had expected. Um, but this is definitely an event. Attacking Iran. Definitely increases uncertainty. And I'm going to talk a little bit about some things that I hope will enlighten you a little bit. I'm going to go down the commentary here in order, and we want to look at some stuff. Just know that things like this, wars do happen. They tend to increase volatility, increase uncertainty in the market. Volatility and uncertainty go hand in hand, and we'll talk about that in just a minute. This could be the start of a correction. I kind of hope that it is, because we're kind of planning on a nice little correction that we want, and we'll, if we get that correction, that'll let us cash out some of the protection that we have on our positions, and then it will let us add more shares and be a good buying opportunity. So before we get to that, I'll just go through. I'm just going to keep going down the list here, so I don't get sidetracked. Earnings coming up on Dollar General and Micron next week. So we'll be looking at those. That's really, we don't have a whole lot of earnings things left for us. The big picture on briefing.com is really talking about AI and the long-term impact. I don't know that necessarily people are still worried about AI so much right now as they are about what the war in Iran is going to cost us in terms of gas and fuel and all that kind of stuff. So whenever there's a threat on Iran, and that Hormuz Canal gets tied up and boats aren't moving through, tankers aren't going through, I think it's a fifth of the world's oil goes through that canal before it gets to market. And right now there's nothing moving through there. So that forces people who are buying from Iran, which are not necessarily our allies, but people who are buying from Iran have to find their fuel elsewhere, and that elsewhere does come out of the supply that we're used to seeing in the market. So it definitely is expected to cause increases in our gas and stuff. The big picture is talking a lot about the S&P 500 and how it's not getting as big a gains on earnings after earnings, because the surprise, it's talking a little bit about how the surprise number. So if you've been participating or watching stocks for a long time, you've probably heard the term whisper number and earnings, surprise and all that kind of stuff. And earnings surprise is just the analysts were wrong, and it happens all the time. And what they were typically doing with a lot of these big stocks, the ones that we invest, Mag 7, Mag 10, Mag 20, whatever you want to call it, the stocks that are carrying the S&P 500 index they've been beating the earnings estimates so drastically that the whisper numbers were really huge. And now the whisper numbers are not necessarily as big as they were in the past, and they're just talking about the earnings not necessarily meeting or being able to keep surprising us to the upside so well. So that's kind of what this is talking about. All right. Sorry. So that's kind of what this is talking about, and it's talking about a lot of the stocks that we are invested in. NVIDIA is one. It had fantastic earnings, which to me justifies the fact that we've got big outlook for that stock, that it can still continue to grow. And so we'll see how that develops over time. This is just a little chart here showing the earnings estimates, forward earnings expectations and stuff versus the actual performance of the index, and how they might be setting the bar a little too high, because the surprises have been so big in the past that all the analysts are expecting another big surprise, and the stocks don't necessarily live up to that anymore, or they're not necessarily going to anymore, is kind of what the article's talking about. Where will our markets end this week? Dow Jones Industrial, we think, is still bullish. It's been doing a little bit better than the indexes. We've seen a lot of sector rotation going on lately, and people are going back into stocks that have been tried and true for long periods of time, trending up, and maybe pulling a little bit of money away from the big tech stuff. SPX, we're kind of bearish this week. I kind of hope it gets down and breaks through this and gives us a nice little. So it's really hard because the market's been a little bit more volatile, but it's not. The moves haven't been big enough to get down to where we can cash out on our protective puts, and so we can buy more shares. And it hasn't moved up enough that we can pull the protection off. And it's just kind of been, you can see right there, it's just been drifting sideways this last month. And sideways that's the most difficult market for us. We need it to move in one direction or the other. And so we've got ourselves positioned, and we just need the market to make a big move up or down. We don't care which way it goes. The NASDAQ composite, same story here. We're probably bearish on that. We hope that it goes down and breaks through that so we can cash out and get some more stuff. Where will SPX end? Maybe down 2%, we think. And I want to talk a little bit about the volatility index, because we get this nice little spike right here. So volatility index is the combined implied volatility of all the S&P 500 stocks, and it's been getting more volatile, right? You can see the moves in the index itself are getting bigger compared to what they were right here in January. We've started to see a lot more wild movements there. So, and this chart is the volatility of the volatility index. So it's just showing you, it's a measure of the volatility of this VIX. And you can see it's been getting bigger and bigger here as well. And we've been getting that little punch up right there. Now, the thing that's been happening, so why with individual stocks, we've been seeing more volatility. Implied volatility has been higher on individual stocks than it has been on the indexes. So I wanted to explain that and talk to you about what's going on. This is the S&P 500 component correlation. And you can see what we had here. This is at the beginning of February. That's the last data I've got for that. It was down really low. And so that, what is correlation of the S&P 500 constituents? If all the stocks are moving up at the same time, this correlation number would be 1. It would be perfect. And when it's negative, or when we get down to almost to 0 or below 0, right, on this scale, it just means all the stocks are moving in different directions. And I've got an example right here. So these are the stocks that you guys are holding. And you can see that today Google is down 524. And if you have an index that contains Google and also contains Meta, right? So Meta makes up everything plus a few pennies. It makes up everything for the loss on Google and Meta. So if your index is holding those two stocks, these individual stocks could get pretty volatile individually, but the effect on the index is a net zero, right? So you can have low volatility on the S&P 500 index and have high volatility on individual components, and that says the index, is not experiencing big things. So what can happen when we have an event like a war that breaks out, and this is just hitting out of the blue, right? Nobody was expecting, maybe somebody was expecting. I don't really trade in these event futures things that they're looking at right now, but that are growing in popularity. Uh, but any event that comes along and like a war that's going to drastically affect fuel prices could alter this correlation so that all the stocks start suddenly trading in at the same time. And if you look back here to this one in 2000, volatility correlation was very low. Stocks are moving all over the place, and the index had very low volatility. And then, boom, you get a steep increase in correlation, and that simultaneously worked with a down market because everything was trading at the same in the same direction at the same time. And so correlation, and so that's something to be worried about. If we get correlation that's really high, like here, and you can see right there, you've got a nice big thing. This is back in 2020 when we got the COVID breakout thing. Everything was trading in the same direction as that dip happened. So when we see a high correlation, and we tend to get, it tends to be a harbinger of very high volatility, because uncertainty, if an event happens and everything's trading in the same direction, it could cause them all to turn around and head down very quickly. And so it just takes a trigger, a catalyst of some sort to come along and cause that change. So this data is not up to date as of right now, but my expectation is that this is higher, and that's because these numbers are quite a bit higher. Volatility expectations, the uncertainty in the market because of this war is causing us some issues. I want to take a look here real quick at those stocks that I had, to just look and see how things were going today, right? So I already mentioned that Google was down $5 and change. Meta was up $5 and change. They kind of washed each other out. So if you have both of those in your account, that didn't really hurt that bad. We have a lot of these others that it's kind of interesting to me that we had some rotation away from the tech stocks, and now that the war happens, people are putting money back in. Nvidia up $5 today, Palantir up $7, almost $8. And so people are looking, when a war comes out and uncertainty comes out, they tend to go back to something that they think is going to be safe and something that will continue to perform, even though expectations are that fuel costs are going to go up, which will be passed down to other things. So it might get a little bit of that rotation that was going away from tech back into tech. We'll see how it goes. This is just one day, so this is just the first day. It'll take time for the market to really digest the news and how things are going to be affected. If this is a short war, and like some people really want, then it could be just a blip to the downside, maybe a buying opportunity, hopefully a buying opportunity, and we'll be able to add some more shares to things that are going to continue to go up, and we'll stick with it that way. Apple, you can look at the Apple chart here. You can see it was down pretty good on Friday, popped back up. It was down a little bit more at the open and then popped back up as people started to try to digest the news. Boeing, I think, is going to be the same way. this one's been trending down, and it looks like it hit a bottom and started to pop back up. Boeing is a defense stock, so they do make, they help make fighter jets and other things like that too. So it is a defensive stock. Disney is not doing great today, down $1.71. Gold is up higher as people hopefully, I'm guessing that they're looking to potentially hedge their dollar with gold. Like I said, Google's down. JEPI, which some of you have, is an interest-bearing thing. It just returns interest. It's kind of like that is real estate investments that pay a certain amount and they're pretty reliable, but it's down a little bit today. JP Morgan, the bank, is down. Some of you have JP Morgan. KeyBank is actually up. Those don't offset each other, but KeyBank is actually up today. And you can look at that one. I think quite a few of you have this, and you can see it did start down with the rest of the market this morning before the market opened. Futures were down, and it started down, but then popped back up a little bit here. So I know for a few of you, I used it to dollar cost average a little bit on your positions to just get that little bit down right there. But we don't have options on there that are valuable enough to dollar cost average with the options yet. So we'll keep an eye on that. But if some of you that had cash, we just doubled your position there just to get a little bit better pricing. Meta is up nicely, and I think that's a telltale sign that people think Meta's not done yet. Micron up a little bit, Netflix up a little bit, Nvidia. I think we just added a bunch of Netflix positions for a lot of you guys. Nvidia up nicely, and I think that's a sign that that's going to be something that people will go to. And Palantir has a whole bunch of government contracts for defense contracts and all that kind of stuff too, and so that might be why that one's doing so good. And I've added Walmart to a few of your accounts recently, and that's one of the staples when we were seeing rotation away from the tech stocks. If we do get into a recessionary type thing, people tend to go to Walmart because they want to buy stuff cheaper, and so same with Dollar General and stuff like that. So when retailers, when we get into a situation where the economy doesn't seem to be doing good, those discount retailers tend to hold up better than the rest of the retail market. So we keep going with that. Economic reports that we have coming out this week: construction spending, ISM manufacturing. That was today. Tuesday we don't have anything, but Wednesday we'll get ADP employment stuff. So this is the employment report that comes from the industry, not the government. We get that a little bit advanced. It doesn't always match whatever the government comes up with, but we'll see that later. Thursday we've got initial claims, continuing claims, productivity, unit labor, business costs, business inventories. Those things could affect average work week. And this is when we get the unemployment rate and everything on Friday, the numbers from the Fed. And we'll see how all that stuff turns out. And really, the most important thing right now that everybody's focusing on is what is the cost of going to war? How long is this going to last? And that's what everyone's trying to figure out, that we just don't know. So the volatility and the uncertainty is just rising really quickly, and that's going to make it difficult for the market to go higher while the uncertainty remains. And so we'll probably see the volatility index continue to rise, and we'll see correlation rise and all that kind of stuff. Anyone have any questions? So the good news, while you guys are thinking of questions, the good news is that we've got protection on most of our positions, and that's gonna work for us if the market goes down, and so we're ready for that. If we see that go down, we'll probably start adding even more. But we need the market to make a nice down move before we can start thinking about cashing out on those puts. If the correction occurs, you said you would cash out the protection. I'm assuming short calls, either short calls. So we actually protect in a couple of different ways. We have short calls that if the stock goes down, those calls that we've been shorted lose value, and we can end up buying those back at a much lower price and pocket the change that way. So we have short calls on a lot of these positions. We also have, in some cases, we've used our short calls to buy the proceeds from those short calls that we received, we used to buy protective puts. And so if those puts go down, we would cash out those puts and then use the proceeds to buy more shares of the individual stocks. Good question, Maud. Yes, so we have two forms of protection that we do that. And so on trades where we have a full collar position where we sold short calls and used that income to buy protective puts. Usually our protective puts we buy at the money, and then our protective, when we short the calls, we typically short them out of the money at a price that we're willing to let exercise. So good. Yep. You got it. All right. Anything else? So while you guys are potentially thinking of questions, I'm going to talk a little bit about some of the news stuff that I saw. Goldman traders see painful path for U.S. stocks before a rebound. I kind of agree with this. So March seasonally, March tends to not be a great month for the market. Sometimes it's down a lot in March, and the theory that we go on, the reason for the seasonality is that people are taking profits to pay their taxes, and so seasonally that's because March comes right before the deadline in April, right, where you have to have your taxes all done. So seasonally, that's one thing going in our favor for a down market. They're just talking here about a lot of things that geopolitical tensions, sharp swings in the market. It just creates a painful path there. Commodity prices are a bit high. It just changes the outlook a little bit. Things maybe aren't having the earnings that we expected them to have. All these things kind of line up together to just make it potentially a bad month. And we are not afraid of bad months. We actually like those bad months. If they go down enough, if we get that nice 10 to 20% correction, we can crash out on some of that and add some shares before things turn around and head back up. I was talking about the effect of gas prices on the economy. That's one of the commodities of all the commodities. Gas prices is an important one to look at because the cost of everything, moving things from place to place, really affects the economy. So gas prices, we we don't want to see them go so high that things are really affected, but we also don't want to see them go too low, because if they go too low, then that's a sign that the economy really isn't functioning because the demand for gas isn't high enough. I don't think that we're in that situation right now. I think that we're closer to the situation where the gas prices might shoot up here and make it a little bit more expensive to do business. So it's talking about retail investors who have been consistently buying the dips are showing less exuberance this year compared to last year. And I would say that's true for now, but if we get a nice pullback, and we get a dip that's meaningful, and that's kind of one of the things they're talking about in this Goldman article, is that if we just have a nice and a big enough correction that everybody can get behind and take profits and get things down to where everything tends to be cheap or undervalued, then we could see a resurgence in the market, and that's kind of what we were expecting. And after taxes, maybe people have refunds that they have money to spend, so we could see it recuperate, market recover after. Apple's moving some of their Mac Minis production to the US. It's kind of interesting. They've committed to spending some money. They're trying to be Donald Trump's friend. When the market drops, how do you know when to sell your puts? What if it drops more after you sell? So typically what we do when we're taking profits on these, what we're looking for is we're looking for the value of the puts that we own to pay for 100 shares of stock. So if you have 400 shares, then you need a 20 to 25% drop in the market to have those options pay out something that's going to allow you to buy another 100 shares. If it drops more after we sell, so typically when we do this, we're taking profits by rolling the puts down, because we're not trying to call the bottom. We wait until the market turns around and starts heading back up before we pull off the protection. But if we get enough money out of a rolling down trade where we can sell the puts that we own and buy another at the money put, and then also be able to buy 100 shares with the proceeds, then that helps. Imagine that you fade the put selling. Yep, kind of exactly what we're talking about. But what do you look for to show confidence that the bottom's near? We don't try to predict the bottom. We really don't, because that's a losing bet. That's a great question, Dave. And I think you've probably heard me say this before, Dave, but it's ridiculously hard to predict a bottom or a top in the market. Your chances of nailing it are just extremely remote. And so what we do is just when it's good enough, we roll those puts down, we take the profits, we buy another 100 shares of the stock. And if it keeps going down, we might buy 2 puts instead of just 1 for every 100 shares that we own. And then we're making money twice as fast to the downside. If it looks like it's going to continue to run, that's probably one of the things that we'll do. But if we're not convinced that it's that kind of a market that is everybody's pessimistic and everybody's selling, then we wait and we'll just keep the protection on, and we keep taking profits when it makes sense to take profits, and just waiting for it. And then when the market turns around, we'll see the stock price change and start heading back up, and look for that. So double bottoms are a technical thing that we look for to say, oh yeah, it made a double bottom. The stock's already headed back up after the second one. We can be bullish now. So we're typically finding bottoms, calling bottoms after they've occurred, not before. So I hope that helps. I'm resigned. I think everybody on the staff, Kevin, Keith, Nate, everybody is on this. We're all on the same page. We're not going to try and pick bottoms and tops. It's just too hard and difficult. So we just choose a strategy that lets us be wrong about our positions, other than we just betting that the stocks are going to move either up or down. So sideways markets are a lot harder for us to really maneuver in, like it has been during the month of February. I think the S&P 500 index was only down half a percentage point, so it's pretty flat. We like it when it makes much bigger moves than that, and that's what we're looking for. So, and we're really looking for the value of our protective puts to pay for more shares, and when we get that cost up there, that we can do that and keep protection on if something's going on, then that's when we do it. I do think it's cool that Apple's gonna have Mac Minis produced here in the US. They're producing servers here in the US as well, in Texas. JP Morgan turned bullish on Netflix. This is one of the reasons why we added Netflix to some of your accounts. And JP Morgan thinks that Netflix is not going to be as that they're not going to be as affected by other things going on in the market as some of its competitors. There are people that are worried that AI is going to be able to let people make movies very cheaply and crank them out really quickly and all that kind of stuff. Their opinion is that AI movies are not going to be superior to human stories, and Netflix has all the stuff that they need to survive anything that AI could put up. So they're kind of happy about that. And some of you guys that have been with me for a long time before, you know how much I like trading straddles on Netflix. At least I did in the past. Then they had some stock splits that really diluted the shares, but I know some of you were with me in the days when we were making money hand over fist on using straddles on Netflix. All right. Yeah, so how long is this war gonna last? Anyone got an idea? 17 days. There you go. I like that. I hope that is absolutely true. I hope that is absolutely true. And it to see the things going on over there, that the people are been rebelling for a while. They don't like there were people in Iran holding up signs that say death to Khomeini. Um, he's had the people living in poverty because of sanctions and all this stuff for so long. The people are fed up with it too. So we just need them to do their part. Now that we've gone in and taken the leadership out, they need to do their part and overthrow. So we'll see. We'll see how. I'm hoping it takes 17 days and the people can take power back over there, because I think they're tired of a regime. Yeah, 2 weeks would be wonderful. I love that. I don't know if it's going to happen like that, because it always takes longer than you want it to. It always takes longer than you want it to. But I think we'll see. We'll see. We haven't had President Trump before in this situation, so we'll see. We'll see how it goes. I don't know. All right. If there's no more questions, I'm gonna let you guys get going, and I think Kevin will be back next week, and we'll go from there. All right. If you have any questions, feel free to let us know, and we'll get back to you as quick as possible. All right. Thank you so much. You guys have a wonderful evening, and we'll see you next time. Bye bye.